In finance, investment options abound, each with its own nuances and rewards. Index funds and mutual funds are popular choices for growing wealth. Understanding their differences is crucial for informed financial decisions. Both aggregate money from investors to invest in a diversified portfolio. This offers diversification, mitigating risk by spreading investments. The key difference lies in their management styles and objectives. Index funds track a specific market index like the S&P 500. They passively replicate the index's composition. Mutual funds are actively managed by professional fund managers. Managers buy and sell assets to outperform the market. Understanding these differences helps investors make informed decisions. The defining characteristic that sets index funds and mutual funds apart lies in their management approach, passive versus active. This difference impacts performance, fees, and strategy. Index funds aim to mirror a market index. They do not employ analysts to pick stocks or time the market. This results in lower operating costs. Mutual funds are actively managed to outperform the market. Managers conduct research and actively trade. This approach has higher expenses. Index funds offer consistent returns and transparency. When evaluating investment options, it's essential to consider the associated costs, as they can significantly impact your overall returns. Index funds and mutual funds differ considerably in their fee structures, primarily due to their management styles. Index funds, with their passive management approach, typically have lower expense ratios compared to actively managed mutual funds. Expense ratios represent the annual percentage of a fund's assets deducted to cover operating expenses, including management fees, administrative costs, and marketing expenses. Since index funds require minimal trading and research, their expense ratios tend to be significantly lower. Mutual funds, on the other hand, have higher expense ratios to compensate for the active management provided by portfolio managers. These fees cover the costs of research, trading, and the expertise of the fund managers. While actively managed funds have the potential to generate higher returns, investors must consider whether these returns outweigh the higher fees. Over the long term, the impact of fees on investment returns can be substantial. Even a small difference in expense ratios can compound over time, eroding potential gains. For instance, a 1% difference in expense ratios over 30 years can result in a significant difference in your portfolio value. Therefore, it's crucial for investors to carefully evaluate the expense ratios of both index funds and mutual funds before making an investment decision. While lower fees do not guarantee higher returns, they can significantly enhance your overall investment performance over the long haul. Now, it's super important to align your investments with your personal goals. Are you saving for retirement, a down payment on a house, or perhaps your child's education? Each goal might require a different investment approach. For long-term goals, you might lean towards stocks or index funds. For shorter-term goals, maybe bonds or a high-yield savings account would be more appropriate. Always take the time to assess your risk tolerance and time horizon before making any investment decisions. So, you're ready to embark on your investment journey? Remember, the key is to start early and stay consistent. Don't be discouraged by market fluctuations. Investing is a marathon, not a sprint. Diversify your portfolio to spread out risk, and keep educating yourself about different investment options. With patience and discipline, you'll be well on your way to achieving your financial goals. Happy investing! Don't forget to like and subscribe for more investment tips.